Hello, everybody, and welcome to my show. My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So, if you find that interesting, please consider liking the video and subscribing to the channel. Speaking of subscribers, we have finally eclipsed the omnipresent level of 300 subscribers on the channel. Sooner than later, we will ascend to new heights. Um, all jokes aside, thank you to my viewers out there. I appreciate you. Uh, I find a lot of joy and fulfillment with performing my work, and you are a big part of that. So thank you once again. Today, I want to discuss a company that I have covered before, that I did give a positive review to, that I also believe is undergoing and is exposed to a ton of the issues right now regarding tariffs. Matson Inc., ticker MATX. If you have not watched my initial video of this, where I dive deep into the business and describe how they make money and really, I call them a shipping monopoly, the shipping monopoly you have never heard of. And while that is true, it also is the choke point of all of the issues that the business is facing currently, given that they are the premium ocean shipping service between Shanghai and Long Beach. So, as you can imagine, given uncertainty around tariffs and Chinese and American trade relations right now, this business is in the crosshairs. The reason I wanted to cover it is because, for obvious reasons, I no longer like the stock right now. The market reflects that. It was at or near all-time highs when I made the video, and really has just trended down. But we see here, Liberation Day has sent shares roiling more than 40% down, and that is not surprising whatsoever. So, today I want to take a look at their earnings that they recently released and kind of use it as information regarding the impacts of the trade war. And also, just kind of elaborate on what I'm saying here. So, I disclosed in my initial video that I had a very small position in the company. I've since exited that position because what I've spent the last month doing is really limiting my exposure, if not trying to altogether eliminate my exposure to trade war factors. And in fact, I want to position my portfolio to benefit from the trade war if things continue to crumble further. So, without further ado, let's get into it. I'm just going to jump into their earnings presentation here, released on Monday. Today is May 7th. This is Monday, May 5th, that they released this. So, their opening remarks. The first quarter of 2025, as expected, was significantly higher year-over-year consolidated operating income. Our China service was the primary driver and benefited from the carryover of elevated freight rates from the prior quarter, combined with healthy freight demand following a traditional post-Lunar New Year period. Now, one thing that we did see, and this was reflected in the GDP numbers as well, was a significant amount of front-loading of inventory of companies based in the United States and consumers, pulling forward a lot of inventory to front-run tariffs. We saw that imports exploded in the first quarter, leading really significantly dragging the GDP numbers down. So while they don't really mention that here, I think it probably goes without saying that the company did benefit from that activity, and as such will be crushed by the reversal in that activity in the quarters to come. They also said higher year-over-year volume in Hawaii and Alaska, and lower year-over-year volume in Guam. Not much to draw from those numbers or from that statement there. Logistics had lower operating income year-over-year, primarily due to lower contribution from freight forwarding and transportation brokerage, partially offset by a higher contribution from supply chain management. But here's the kicker right here, folks. Lowering 2025 outlook due to uncertainty. There is significant uncertainty regarding tariffs and global trade, regulatory measures, the trajectory of the U.S. economy, and other geopolitical factors. So, breaking it down by service, the Hawaii service, again, this is one of two companies, I believe, that basically has a duopoly on Hawaii shipping. They are headquartered in Hawaii and got their start in Hawaii. So, this is a Hawaii legacy, one of the original Big Five Hawaiian companies that was spun out from Alexander and Baldwin, several decades back. So the Hawaii service is a legacy business, but also a big profit driver. So container volume increased 3.2% year over year due to the dry docking of a competitor's vessel they benefited from. That gives you an idea of how few players there are in the Hawaiian market where their container volume increased several percentage points, mainly attributable to a competitor's vessel being dry docked. The full year outlook for Hawaii, expect volume in 2025 to be comparable to the level achieved last year, reflecting modest economic growth and stable market share. I'm not sure what U.Hero is, but I would imagine that it's a University of Hawaii Economic Resource Office, and I'm guessing there. But we're showing here kind of what the office believes. They are estimating a slight downtick in tourism. In fact, a lot of the data that we've seen in light of the Trump 2.0 term is that foreign travel, particularly to the United States, has steeply drawn down from what it was prior. However, whether or not that is the magnitude of effect that has on Hawaii remains to be seen. I would imagine that Hawaii continues to have strong domestic travel. U.Hero is projecting stable tourism, but we'll see. This is the big deal here for the China service. Significantly higher rates year over year, elevated freight rates from the prior quarter carried over into the first quarter. I would expect those to come way down for obvious reasons. You see here, although they had higher rates, container volume did decrease. So that's interesting, even though we had, as seen in, again, the mentioned GDP numbers, imports come way up. We actually did have a decrease, at least over the prior year quarter. And we see, over the last 3 quarters of last year, container volumes were very strong. Very interesting to see what happens in the following quarter here. This is the meat and bones of what we're trying to get at here. The current business trends for the China service. Currently, there is significant uncertainty regarding tariffs and global trade, regulatory measures, the trajectory of the U.S. economy, and other geopolitical factors. Since the tariffs were implemented in April, our container volume has declined approximately 30% year over year. It's not surprising, but it is significant. When I made this video, I believe it was in December, maybe early January, that I made my video about this. He ran on a platform of tariffs. However, the tariffs that were announced on April 2nd, otherwise known as Liberation Day, were a significant step up from what I was anticipating them to be, based on what him and his advisors publicly facing had guided to. As you can imagine, a company like Matson was probably caught off guard by that quite a bit, as well as investors. That's a real metric. One thing that I've been looking at but haven't really made a video about, maybe I should, is the actual container volumes coming into the port of LA, Port of Long Beach. Of course, we know Matson has a large terminal there for their dedicated shipping service. The numbers, we saw that borne out in the data of the container numbers coming down. But they stated here that given the pronounced market decline in demand in the Trans-Pacific in April, coupled with limited visibility to our container demand, we expect the second quarter container volume and rates to be lower year over year. And the full year container volume and average freight rates to be lower year over year. That shouldn't be surprising, but that is a strong, very credible anecdotal data point. Working closely with our Asia transshipment partners as our customers look at options to diversify and grow their manufacturing location. So the company is still positioned as a premium expedited shipping service across the Pacific. However, the dislocation created by the trade war does, even if temporarily, throw a huge wrench in volumes and rates. And I think that the commentary by the management team really validates that idea. I think it's very simple to understand and not surprising given what we know now. We will continue to follow our customers as they reposition and expand their manufacturing footprint in response to changing tariffs as part of our catchment basin strategy in Asia. In other words, like I just said, a company is moving elements of their upstream supply chain out of China and into Vietnam, into Malaysia, into Thailand, into Indonesia. And given the presence that Matson has in the Pacific shipping lane, they're saying, hey, we're already positioned to provide this service. Therefore, why don't we just connect that shipping lane? We see that here. In the first quarter, they announced a new direct service connecting Ho Chi Minh in Vietnam to our CLX and MAX Shanghai departures. So connect to China, providing the fastest connecting times out of Vietnam, expansion based on success and customer feedback received since launching our inaugural direct service connection from Haiphong 2 years ago. In the near term, they expect higher volumes from Vietnam. We are well positioned with our multi-year transshipment relationships to scale up as expedited freight volumes grow in the region. However, they expect the uncertain environment to accelerate the diversification of our catchment basin in Asia. So that's pretty positive. That's a mixed bag of positive and negative, but that's pretty positive to see that the management team being very adept and looking to capitalize on the shift in supply chains on the Pacific. The company is well positioned to capitalize on that. Now, whether that actually translates into overall revenue and profit growth for the company versus what it would be out of China, that remains to be seen. And that is the basis of the uncertainty right now. So while me as a potential shareholder, again, I mentioned that I sold my shares, but still obviously paying attention to the company, still really like what they're doing. There could be a point in time where as the numbers start to trickle in as to how that service is doing, how their volumes are, how their pricing is along the new shipping lane or the extended shipping lane, in addition to China, that might ultimately be very bullish. But I still think that it's too early to make a judgment call based on just their action here. So here, what they're saying here, and I echo and agree with this sentiment very much. They say that they believe we're in the early innings of the U.S. China trade negotiations. I think that that's a very, very fair and sober assessment of the way things stand. Just the S&P 500, the Nasdaq, everything has been trading on a wave of optimism, expecting this fast conclusion. Personally, I don't believe that is the case. I don't think it's the base case. So while I don't think it's a good time to sell everything and just position against that ever happening, I think as investors, we need to be very, very conscientious and willing to accept that the U.S. China trade negotiations will take longer. I think more eyes in the marketplace should be on this earnings report and on this company, given what they're saying. This is a company that is on ground zero, right, boots on the ground in terms of U.S. China trade. They are saying, hey, this is going to take longer. This is what we're doing about it. So I think that's really important. I think that's the vital piece of information we need to take from this report, if anything. They expect disruptive conditions in the Trans-Pacific, with ocean carriers blanking China sailings and implementing service changes due to lower volume in response to the tariffs. We also have seen some carriers add ports of call and increase capacity and allocations in streams from other Asia origins. That's kind of what they were positioning for in the prior slide. At some point, retailers will need to continue to restock their shelves or risk significant inventory issues. We also expect consumer demand for e-commerce goods will continue to grow. Matson is a trusted supply chain partner. They expect to run our business like we always have, with a focus on speed, on-time arrivals, and customer service. The solid relationships with partners in the region provide opportunities for further diversification of where our freight is originated. We have the resources and assets to move quickly to adapt to a changing environment. U.S. Trade Representative, the USTR. So this is April 17th, following the EO on April 9th. April 9th was also, I believe, the day that the stock market bottomed presently. Relevant actions and proposed actions. Certain service fees on 1, the maritime transport services of Chinese operators and ship owners, and 2, operators using Chinese-built vessels on a non-discriminatory basis. Effective on October 14th, 2025, annual increase to service fees. Each vessel will be charged a maximum of 5 times annually. So the U.S. Trade Representative is proposing additional duties on ship-to-shore cranes, containers, and certain chassis of China. Exemptions. A group of small vessel operators received exemptions from the USTR: short sea shipping, Great Lakes, Caribbean, and small vessels. Matson is exempt from the USTR's notice of action due to our size, but is still negatively impacted directly by lower volume and indirectly by merchandise tariffs paid by our customers. Notice how that is in big, bold text. Before we move on to the other results, we're not going to spend too much time on the other results because, frankly, they're not as relevant as the China service observations. I think that there is a huge bit to be concerned about when contemplating an investment in this company. There are shipping companies out there that are much different and frankly inferior to Matson. However, they do happen to pay much more substantial dividends, multiple double digits dividend yields on. And the takeaway there is that shipping is a volatile and risky industry for investors. Matson has been more of a best-in-class stock in the sector to own. Their capital return policy is to shareholders is very conservative. They have a very low payout ratio and steadily increase the dividend over time. The reason I'm bringing up the dividend is, as a shareholder, the egregiously high yields on some shipping stocks like Zim or Torn, or I get that they're different types of shipping and different lanes and all that. I get that, but the egregiously high yields do somewhat compensate investors for the absurd risk in shipping. There's more risk in shipping now than there was a year ago. I think that's obvious. The thing about this stock is that it continues to be at a premium price with a low shareholder return, at least in terms of the cash dividend. And they are warning us. They are warning us that there is volatility ahead. So here's the deal: these numbers do not encapsulate the really much of the impact of the tariffs. They just happen to disclose the way that volumes were trending. 30% down year over year is significant. So I think that's pretty spooky. If you're contemplating an investment in this company, buyer beware here at these levels. I think that even though the shares have significantly sold off from their all-time high of 160 a share, we're less than 100. There's a larger margin of safety. However, I do believe that there is still a strong amount of downside risk in the shares at the current price. So I did talk about in my initial video how this company was exposed to the potential trade war. What we're seeing now in this follow-up video, and what I'm reiterating to you, is that the trade war is much more severe and much more disruptive than I would have anticipated, and it increases the risk in Matson shares quite a bit. The fact that they are expanding into these new service lines and these new shipping lanes to capture the traffic that conceivably will move to Vietnam or to India or whatever, Here, all they're talking about is Vietnam, but they don't necessarily specifically call out any other nation other than Vietnam. So again, what we're seeing, Vietnam continues to be a winner in the trade war so far. But I like what I'm hearing about them moving the shipping lanes and assessing that risk and doing what they can to mitigate it. However, there's not enough data yet for me as an investor to feel um, like there's a strong margin of safety there. So there's a lot to like about the actions they're taking, but it is far overshadowed, in my opinion, by the drastically increased level of risk that we see in the trade war here that it's creating on the shares. So hopefully that makes sense what I'm saying. So let's move on. We'll just kind of breeze through these other pieces here. The Guam service container volume decreased 14%. That's pretty steep. In fact, that's the lowest volume seen over the last 5 quarters, as we see here. And the container volumes kind of continue to trend down along this wedge line here. So Q1 in 2024 was actually the best quarter of the year. If Q1 2025 is our best year or best quarter of 2025, that spells pretty weak volume for the Guam service. However, if we just kind of compare, this is 4,000 units here versus the 28,000 in China versus the mid 30s thousand volume. The Guam service is a small contributor to volume. Alaska service container volume increased 4.8% year over year, higher northbound volume partially offset by an additional sailing. Expect continued economic growth supported by low unemployment rate, jobs growth, continued oil and gas exploration, and production activity. I'm not so sure if I buy that given the price of oil now and the commentary that we've heard in recent days from oil and gas executives, particularly the executives at Diamondback Energy, where they discussed that production, they believe that shale production has peaked in the United States. So I'm not sure that I buy this. In fact, I would anticipate the opposite due to very weak pricing in energy commodities. But they do expect volume to be comparable to the level achieved last year. So again, we see container volume in Alaska is the third out of the fourth smallest size there in terms of their volumes by service, but those numbers are good. So Hawaii and Alaska volumes increased, and they expect steady or increasing container volumes there. However, China being a big volume contributor here, there's a 30% decrease year over year from here would drop us all the way down into this 30,000 ish range. So, in other words, based on what they're saying, if that were to continue throughout the entire quarter, we would essentially see this light blue bar be replicated in each of these subsequent 3 quarters there. So that's a significant drop in volume for the China service, but not necessarily a significant drop in volume for the business at large, maybe a mid-single digit drop. So while that's not as catastrophic as you might think, it's still pretty significant. And then the SSAT, the terminal joint venture, I believe that is our terminal asset in the Port of Long Beach. So obviously these numbers look good, but they expect the contribution to be lower than last year. And then logistics is a smaller segment. Um, we see that freight forwarding and transportation brokerage lower. Another thing that we've been watching, because you have so much container volume decreasing from China to the United States, that also means that trucking rates, particularly trucking rates in California, expected to come significantly down if they haven't come down already. So I would expect, while I don't know the geographical footprint based on this slide of their logistics operation, I would expect a fairly weak year in logistics as well. Okay. So they have 122 million of cash in the quarter ending. That's less about half as much as they had at the end of the prior quarter. We don't have a cash flow statement here, so we're not going to tie that out. I guess they have here. We see they did buy back a significant amount of shares in the prior year. It'd be interesting to see what they discuss in the upcoming. Let's just review these closing thoughts here. We're navigating an unsettled and rapidly changing environment. For the last 2 decades, we have operated our expedited ocean service through significant periods of uncertainty and disruption. We've come out of those periods better for it as we demonstrate what we do best for our customers, which is to be a trusted supply chain partner. We believe we are in the early innings of the trade negotiations and expect a deal to be reached, although timing is unclear. Despite the current uncertainties, we remain confident in our long-term prospects due to the diversification of our businesses and cash flows, our focus on serving niche markets where we are an integral part of the supply chain, the strength of our balance sheet. Our businesses are durable and capable of withstanding short-term fluctuations. We remain committed to maintaining the reliability of our vessel operations, providing high-quality service. Matson has over 140 years of operating history and has historically performed well during periods of supply chain disruption, given our competitive advantages. We expect to continue to return capital to shareholders through dividends in our share repurchase program. So there you go. They're not guiding to any sort of suspension of share buybacks. They just talked about how they expect volume and freight rates in both the second quarter upcoming and the full year to be lower, but they didn't actually guide to what that is. That's probably smart for them to do so. I want to balance my thoughts with what they're saying because, again, what they're saying there is we've been around for a long time, we're not going anywhere. I believe that, and I think that they do have durable competitive advantages, especially within a sector that doesn't really have a whole lot of those. So I think that the stock is still a tantalizing prospect. However, what I'm not interested in accumulating here at the current levels is the tail risk of trade negotiations taking much longer than they are supposed to, given what the market's pricing in, or for a deal not to be struck at all, or worse, for the situation to devolve into a much more nasty conflict between uh, China and the United States. We see here breaking Federal Reserve keeps rates on hold for third meeting. I'll take a look at that later. But that's interesting, not surprising. So the shares here are much more attractive, at least in terms of dollars and cents. They're much more attractive than they were when we looked at the stock last. So the stock continues to be trading at a fairly attractive multiple of earnings, a fairly attractive multiple of revenue, a fairly attractive multiple of the book value. So, again, this is in relation to the industrial sector, which includes marine transportation. However, if I wish we could see relative to the marine transportation sector, we would see that these multiples are actually probably a little rich compared to marine transportation. But that being said, there's not many businesses you can acquire on the market today that have the underlying advantages that Matson has that also have such low multiples. So the valuation continues to be attractive. The dividend, while it's not very large, continues to be attractive as it is steadily increased. In fact, they've grown it for 11 years and paid it for 35 years. Very attractive dividend, very attractive capital return policy and balance sheet. They have a fair amount of liquidity, 122 million of cash versus only 340 million of long-term debt, which they've been paying down. They continue to acquire vessels. At least they did last year. You saw there they spent like 160 million on a new ship or maybe several. But so I think I'm very interested in the stock. I just right now I don't really love the risk reward that we're sitting at here. Now that being said, if there were to be a deal reached, let's say that there was a deal announced tomorrow, and of course there will be given my timing with my videos here. But let's say that there were a deal announced tomorrow that says the China and U.S. not only are there no tariffs, but there's all these super favorable provisions in this trade deal for the United States and for China. A true win-win deal. Part of the deal, everybody claps. The stock market, goes up by 10 points in one day or whatever. It's conceivable to think that in a scenario where the tariff risk is alleviated meaningfully and altogether at once, that this stock will explode on that announcement. I think it's very fair to make a directional bet on the share price here. However, management is saying that they don't believe that that's going to take place anytime soon. They are very skeptical about that, and so am I. So, with that in mind, I think we have to continue to avoid the shares here of Matson because I see there being more downside risk than upside at the current share price. What would change my mind about that is simply for us to exit the uncertainty of the trade environment. That uncertainty, however, does create opportunity in the share price. It already has. It's much lower than it was. However, I still think it could fall further. That being said, I would never contemplate shorting the shares, even though we do have a pretty strong short interest here on the shares. I wouldn't consider shorting shares because, first off, I don't like to do that. But second off, because for the reason I just mentioned, if there is any positive development in the trade war, the shares will roar. They will rip up. That would be my belief. And if you are shorting the stock at that time, you will get demolished. So I would never recommend any sort of financial advice on the channel, but I would never even hint at any holding being short. And furthermore, I would especially not hit that on these shares here. But I do believe that the risk reward is non compelling despite the valuation looking attractive. So that is going to conclude our video for Matson here. Hopefully you found this interesting. I've certainly had a good time walking through it with you. I think there's a lot to be optimistic about when we look at those reports, the earnings report, particularly around how the management team is attempting to position the business to capture a lot of that activity from Vietnam. I certainly would be very curious to see if they start to report numbers on that type of stuff in the quarters to come. If they do and those numbers look very good, it might change my mind about the shares. However, I think the strongest indicator of my bullish sentiment when it comes to this stock would be the price and what management is saying. I think we really need to pay attention to what this management team is saying about the state of the trade war and the shipping volumes. And so far, I think there's a lot to be concerned about. So while I am cautiously optimistic about the long-term prospects of the company, and I do have a fair amount of confidence that they will be able to ascertain more shipping volumes as the shipping lanes correct and move. That's just a narrative right now. There's no hard data of that. So I'll be eager to see that data once it comes through. But until then, I think we simply have to avoid the shares of Matson. So, anyways, hopefully you found this interesting and appreciate you again for tuning in. If you've made it this far, please consider liking and subscribing so you see more content like this. I will continue to deliver. And in the meantime, I hope you have a great rest of your day, and I will see you soon. All right, thank you for watching, and